Thanks to the current stock market crash, we have the opportunity to turn $0 into over $4 million, starting with the average college graduate starting salary of $55,260. The plan is to invest 15% of that salary every year, which is $8,289, into one single dividend stock, and then let dividend payments, dividend growth, and share price growth do all the work for you. All right, let's get into it. The average college graduating salary is around $55,200. We did the math. I told you it's $8,289. And if you split that up by 12, that's $690 a month. We are starting at the age of 22, investing for 45 years until retirement, the age of 67. The estimated annual gain is going to be 9%. That's what the stock market does on average, just the S&P 500 does on average over the last 100 years. The fund I'm talking about and my favorite dividend ETF, the SCHD ETF, actually has done far better than that. So this is conservative for the history of this fund, which is not a guarantee of future returns, obviously. But here's how it works out, right? You might think 45 years is a lot of time. Well, that's what it takes to build true wealth and not somebody just trying to sell you a course or sell you an overnight get rich quick scheme. But $4.3 million is a lot of money and it's worth the wait. Now, this is still life-changing money along the way, right? At year 20, so this person would just be 42 if they started at 22. In the low scenario, which is 8% per year, it'd be worth $378,000. The high scenario of 10% a year would be worth $474,000. By year 30, we've now hit the $1 million mark on the high side, right? So the 8% annual gain is at $937,000. 10% annual gain is at $1.3 million. Then fast forward to year 44, 8% gain, you're at $3.2 million, 9% gain, $4.3 million, and 10% annual gain, $5.9 million. And we're going to say, using SCHD, that you got to age 67, you had that $3.2 million, you took half of that out of the market and just put it into cash or some, safe money market fund, and then lived off that and took $40,000 or $50,000 a year out and just lived off that. You still have $1.6 million invested. That's going to pay $54,000 in annual income using SCHD, the dividend ETF. I'm going to talk about the process of that fund, the stocks in the fund, and then the risk associated with that fund as well. But it pays a 3.34 dividend yield. And the dividend growth is incredible. It's been 13% over the last 5 years. And so if we are, again, living off that 1.6 million at that point that we took out of the market and drawing out of that, and then just leave this in, we're not adding anything more at that point, but then you're just letting the dividends reinvest, not adding anything. Again, you get 10% dividend growth rate per year and then a 3% boost because you're doing the dividend reinvestment. So that's 13% growth per year. The dividend income, again, you are reinvesting this income though, but this is the dividend income it reproduces. In 10 years from that time frame of starting that, you're earning $186,000 in dividends. And then 20 years, and at this point, the person would be 87, right? So now we're talking about generational wealth for kids and grandkids and all that stuff. $631,000 just in dividend income a year. And even if you go to 10%, the growth rate slows down, the reinvestment slows down, whatever, still life-changing dividend income. And that's money that you could leave invested at that point in your life because you're living off that 1.6 million that you took out, and just take care of your family, the next generation, charitable causes, whatever. All right, it sounds crazy to just invest in one stock or one fund, right? And this isn't a recommendation. This is just for entertainment. But the Schwab Dividend Equity ETF SCHD gets a 5-star rating from Morningstar. And the way that this works, the reason it's so incredible is because it takes stocks out of the Dow Jones US Dividend 100 Index, looks for stocks that have paid dividends for at least 10 years and have strong financial health to continue that streak. It takes out anything that has a market cap less than $500. It excludes REITs, does not have any REITs, and it takes out anything that hasn't paid dividends for at least 10 years. Then it ranks all of the stocks by indicated annual dividend yield and screens out those that rank in the bottom half. The remaining stocks receive a composite score that equally weight in 4 metrics: cash flow to total debt, return on equity, yield, and 5-year dividend growth rate. It ranks those stocks by their composite scores. The current holdings that rank in the top 200 remain in the portfolio. The index then adds the highest scoring newcomers until the portfolio has 100 names. So it's invested across 100 names, well diversified. It has a process for identifying strong companies that are safe and have a growing dividend. So people are managing the risk for you. You don't have to worry about owning individual stocks. Then it maxes a stock's position. One single stock could only be 4%, and one single sector could only represent 25%. There's risks associated with everything, but the process they use makes sure that there are very solid holdings in this company with a history of strong earnings and strong dividend growth, and it caps the sizes and the exposure to any single sector, which takes the risk down another level. Let's talk about the companies in this portfolio. They have an average price to earnings ratio of 11.2, which is below the average of the S&P 500, that's around 15. And the top 10 positions are Merck, Amgen, IBM, Pepsi, Lockheed Martin, Pfizer, Cisco, the Home Depot, Coca-Cola, and Texas Instruments. Positions 11 through 20, Broadcom, Verizon, Automatic Data Processing, BlackRock, Altria, EOG, 3M, Illinois Toolworks, US Bancorp, Valero Energy. And since we're talking about it, let's jump over to risks, right? And again, past performance doesn't mean that that's what the future is going to look like, but the risk versus the category is below average. The returns versus the category is high. And the biggest drawdown was 21% during the COVID crisis, right? So if you think that you've invested and you've earned millions and millions of dollars and you're living below your means anyways, and you have, dividend income to live off of essentially, then a 21% drawdown isn't even that bad, really, because you've just been investing for so long. That's the secret to becoming a millionaire in the stock market. Saving 15% or more of your annual income, that's the goal. Growing your income over time, investing more over time, finding a great fund. I love SCHD. Find funds that you like yourself, and then sticking to the plan and not getting scared out when there's doom and gloom and everybody's talking about how bad investing is. This is the time to be investing.